gotta leave your money behind you. Raise your hand to...
Welcome back to Gimme Some Truth International. Dame la verdade, dis-moi la vérité. It's been a while since we've been in the booth, but we're already several weeks into 2023. It doesn't seem like we're that far into the new year, but January has been a pretty good month for markets, and for what we're going to talk about today, Stan, international markets. It's also been off to a good start for international markets as well so far early on in 2023.
So far, so good. What a pleasant start to 2023. Most asset classes have enjoyed, really. Stocks and bonds and foreign and domestic, and everybody should be slightly relieved and not necessarily ready to declare the death of the bear market, but it's starting to look more and more like the beginning of something good.
So we're going to focus here mostly on international markets, and we both wrote our year in review pieces on the international markets. You focus more on currency and questions of currency and currency kind of since we almost hit parity. Kind of 2/3 of the way through the year last year has started, in terms of the euro, other currencies, we've started seeing some of that come back. What do you think accounts for that shift? What's that, shift mean? One thing as well, we're not going to get too deep in the woods of where currency is going to go over the next month. I tell my clients, if I knew that, I wouldn't be talking to them. I'd be lying on a beach somewhere, pretty much retired. But, over the long run, you can identify certain trends. And so what are some of the trends that we've seen coming in?
Well, I mean, that's a loaded question. I mean, so let me just back up by saying that the dollar itself was on quite a tear, right? And in fact, the dollar and ergo domestic U.S. investments, U.S. stocks in particular, right, have outperformed foreign, ergo non-dollar based companies, securities, over quite a long haul, right? Throughout this last decade, as we got into our recovery mode out of the Great Recession, and all the way through into the first 3 months, first 3 quarters of 2022. So whenever you have, a long trend like this, it's something that people have been, expecting will eventually, reverse itself. But, oftentimes longer term trends need to kind of have a blow off top, right? And it's never easy to predict the end of a long term move like this, but the signs are all there now. And one of the signs was simply that the dollar index climbed 5% each quarter for the first 3 quarters of last year, which is an extraordinary jump, right? So the trend was going up, and then it kind of moved parabolic. And it peaked in, I think, maybe September 24th, and then declined significantly, I would add, for the fourth quarter of last year. And here we see a continuation of that dollar weakening just a little bit so far a month through 2023. So we're getting, signs that this, this pullback, if you will, in the dollar may have legs, right? Mm-hmm. It may be the start of something more.
And so there are a couple of, things I think in 2022 that affected American markets, that affected global markets, that directly tied to, that weakening exchange rate. And as we'll talk about here in kind of the second half, that led to some knock-on effects for stock markets. But, the first thing is the war in Ukraine. And for us who talk to clients based in Europe, here in the United States, that's become something that we kind of don't, pay as much attention to. It's kind of moved off the front pages. but it's still, important and crucial to things going on. But that led to a certain flight to safety in Europe, right? You want to get, there could be World War III in Europe. You want to get your assets into a safer currency than the euro, and look to the U.S. is generally the safe place, right? So that's one thing that we saw. The other is, the U.S., and we've said this before, acted, probably to some minds belatedly on inflation, but even belatedly, they've moved quicker than a lot of the rest of the world. So
Sure.
If you're sitting on deposits, do you keep them in your bank where for a long time in the Eurozone and the rest of the world, they were paying negative interest rates still last year? Or do you move them to the U.S. where, the interest rates were moving up? Again, something that increases demand for, the U.S. dollar versus global currencies. So, that kind of knock-on effect, and what we're seeing, I think, is a little bit of the unwinding of that.
Yeah.
The rest of the world has, come to start raising interest rates, at least normalizing them. They may not be as aggressive in fighting inflation like the Fed has. And then as well, I would say, the growth in the rest of the world, despite, all of the geopolitical worries that we always have, and, if you look for things to worry about, in the world, you can find them, right?
Oh, yeah, and geopolitical beyond the Ukraine.
Yep.
I think 2022 is going to be remembered as the year where Biden became, the real, the real tough guy on China, right? I mean, literally telling, certain U.S. companies, you cannot sell to Chinese customers anymore. And kind of furthering that dialogue here in the United States amongst the investment community, started calling into question whether China was even investable, right? So, I mean, I'm sure that contributed to flight to dollar investments as well.
Well, especially
You've got the second largest economy, and you're calling it into question as whether it's a viable investment, right?
Well, and especially for wealthy Chinese investors as well. They look at the U.S. dollar and they're worried about, and China had a rough 2022 and is having a rough start to 2023. A lot of that having to do with COVID and their policies there. And one of the things as well for China that, doesn't get talked enough, but because of the zero COVID policy and because of COVID more broadly, a lot of companies have started diversifying their supply chain away from China. And so, China has, big question marks, and Chinese investors, again, that flight to safety, right?
Yeah.
And I think, when you had as much saber rattling as last year, when you had real live war, that leads foreign investors to go to the U.S.
I mean, immediately when Russia started to, invade some of its, old areas, the immediate concern, of course, is Taiwan, right?
Yep.
In the East is kind of a corollary, and China certainly, made provocative moves with their military and their navy as well. So we live in unsettling times in that sense.
But again,
as an investment thesis, I'm sure Keith will agree that the more you focus on these things, the more the more your returns are going to suffer, not benefit from your paying attention to the headlines and the politics.
Yeah, and I think, there are 1,000 cases for things that can go wrong in terms of the markets,
Always.
if you want to find negative things. But, in spite of all of the things that we hear about, here's where this has been bad, or we're worried about this or that, and because of that, the rest of the world is in, rough shape. What we've seen, though, is despite the U.S. outperformance, the rest of the world is actually, in terms of GDP, growing faster.
Yeah.
And part of that is, you have to, and right now it's been very easy to keep your money in the U.S. and get returns,
Right.
Investing in the blue chips basically is, the biggest companies have really driven the last 10, 12 years of U.S. outperformance.
Indeed.
And, part of that is because of lower interest rates in the U.S., right? It is very easy to take that on if interest rates come back to a higher, more what we call normal level, there's going to be more risk involved in U.S., investing in U.S. markets. And some of these global risks that we've been talking about, I think, start to fade into the background because, again, as I said, over the last sort of, 10 years in terms of what we've seen in international markets and what has been, outperforming the GDP of the rest of the world, but you have to go to smaller countries. The U.S. is a big country, and it's really hard to grow as fast as a smaller country. Law of large numbers and all of that. So, things like emerging markets, things like markets that haven't been seeing that return start to, once you have to take risk, that starts to, those geopolitical risks become a little less unsettling, I would say.
Yeah. Yeah. So, I mean, as soon as the dollar, kind of completed its fantastic move, this was an excellent time. Probably, not by reading the headlines would you ever get, a taste of this or a flavor of this or a notion to do this, but it was a very good time to flip into to more international stocks, and the market returns have shown this, right?
Yep. No, and
last quarter of last year, first quarter of this year, guns a-blazing.
Yeah, and if you look over the last, in 2022, a lot of people don't realize, but, the rest of the world, there were actually markets that were up last year, In local currency terms, the United Kingdom was up 7% last year, but that got erased by a weak pound, right? And so you ended up losing about 5% in the UK.
Right.
If you invested in India, you were up 3%. Again, strong dollar meant in US dollar terms, you lost 7.5%. And so going into this year, now you're getting that tailwind. And so, when you compare something like Europe's performance versus, many of our clients use something like Vanguard's VGK. Yeah. You're seeing, better performance now than in the local markets because you're getting that tailwind from the currency. So, for instance, France, the CAC 40 year to date up 9.4% just by way of comparison so far, and this is of February 1st. By way of comparison, U.S. markets are up 6.3%, right? If you look at just the EFA index, right, up 6.3% in local terms, 8.1% in U.S. dollar terms. So you're starting to see, Europe ex-UK 7.9, U.S. dollar terms 9.4 year to date. So you're starting to see, maybe we'll finally see that shift that we've been wondering when it's going to come for a long time. And if you've listened to us on these podcasts, we've talked about how the rest of the world is, basically, this is the longest stretch where it's underperformed U.S. markets.
Yeah. And, I would say that just anecdotally, through conversations with clients throughout Europe, do you think that, that these European markets are outperforming now because the headlines are more rosy? No, of course not. I mean, pessimism still rules the day, right? But when it comes to the UK, it's still like Brexit's been rough and our government is in chaos. I mean, it seems to be the reply you'll get from clients when you say, how are things over there? Yeah. Right?
But, one of the things...
that's not an investable thesis to sit there and try to, put your finger in the air and say, all right, how's the wind blowing here? Are things getting better or are things getting worse? Because, the headlines will always sensationalize what you should be worried about, right? Not like pointing out like things, underneath all of that are in fact improving.
Well, and the other thing is, when we think of, Europe in particular, rest of the world, we think of it as kind of staid, slow economies, but there are areas where, the rest of the world is doing a better job in terms of their, investing. You can look back at what are called thematic indices. Yeah. And over the last sort of, 10 years, there are a couple of areas in the rest of the world that have outperformed the U.S., right? Right. Investing in clean energy. If you bought a clean energy thematic index about 10 years ago, you probably did just as well, if not better, than the U.S. market. Likewise with luxury goods. Yeah. That is an area, and that's an area where that currency story, that helps, luxury goods, where the cheap value of the euro versus global currencies meant your dollar, your yen goes farther for the Louis Vuitton handbag or the
Right.
fancy pair of shoes from Salvatore Ferragamo, and that was good for European sales. So
Right.
again, we always think of big companies, BMW,
Yeah.
this, but there are a lot of other stories in play in the rest of the world.
That's a really good point, right? So, I mean, one thing that I pointed out in our outlook, 2 years ago, not last year, but like literally 2 years ago, was, hey, look, the S&P 500 looks out of balance now, right? We've seen a recharacterization of communication services and retail to encompass more tech, to kind of hide and guise the fact that technology all of a sudden is a third of the index, right?
Yep.
We've had the rise of, you mentioned, the mega cap companies, the Amazons, the Metas, the Alphabets, the Apples, the Microsofts, right? And it seemed kind of out of balance, right? So besides the currency diversification that you get through investing in a European fund or an Asian fund or just an overseas fund in general to own non-dollar assets is, different investment themes work better at different times, right? And my article from the 2001 outlook 2 years ago, 2021, pointed out that energy was then 3% of the S&P. Do you know what the best performing sector in the market was last year?
I'm going to guess energy.
You are correct,
Yeah.
right? So having Total and BP, as a bigger part of your index, not bad, right?
Yep.
I mean, so
Well, and that's-
luxury goods, as you mentioned, we certainly, one thing I have checked in the headlines is that there seems to be no shortage of ultra rich people,
Yeah.
right?
Yep.
So I mean, just
And those
open
aren't
your eyes
yeah.
and realize that, like, the U.S. market itself, especially when you're weighting it by market cap, right, can get kind of out of balance, right? And there are ways to fix that through adding like a value tilt or just a different kind of tilt to the traditional index. And part of that tilt can also be towards international.
Yeah, I think that's one of the things as well that you tend to see if you look over is that U.S. markets, have a little bit more of a growth tilt, right?
Right.
And so in a period like, 2020 to 2021, they can go gangbusters and you won't necessarily see the same outperformance from Europe. But when you get into volatile markets, when you get into a pullback, when you face a recession, because they never got super overheated in the European companies, you're not going to see that huge pullback, and Europe has a little bit of a value tilt for it right now.
A value tilt, and just like emerging markets have an energy or commodity tilt as well, right? Lots of utilities, lots of Rio Tintos and the like.
Yeah, and with the currency story, that allowed you to hopefully work with your advisor and buy the rest of the world when it was on sale. Yeah,
very cheap.
So that's all for us today. Stan is going to put out some more content here as well this afternoon. So we're getting back into the swing of recording, and we want you to take a look at as well. I think there's plenty of stuff in our investment guide to keep you warm at night over the next February, where it's
or help put you down.
Yeah. But want to thank you for listening, and thanks for listening to Give Me Some Truth, and we'll be back again soon.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.